Hey, this is Arthur Hill, Senior Technical Analyst with StockCharts.com. You are tuned in to On Trend, the show designed to keep you on the right side of the trend. So it is Tuesday, February 26th. We got an action-packed show for you today. We're hitting a resistance level for the third time. We'll see if it works this time. The breadth and trend indicators remain strong, though. We're going to dive into SPY and QQQ and look at the top stocks. The bond ETFs are winding up and could be poised to move soon. Energy and communication services are lagging, as is Tesla. So technical analysis is a bit art and a bit science. And because of that art or subjective part of technical analysis, it is not perfect. There are going to be good calls and there are going to be bad calls. There are going to be textbook setups that don't work, and there are going to be setups you never imagined working. And that's just the way it is. We just have to keep plugging away. But the reason I talk about that now is because, there was a classic resistance setup in the middle of January, and it didn't pan out and mark resistance. We had another resistance level in the middle of February at the 200-day. It didn't work out. And now we're at the third one, so maybe the third time will be the charm to give us that all-elusive pullback in the S&P 500. So I'm going to give a live annotation of this chart so you can see how the thinking works here, even though it didn't work out. But basically, I'll start with this rectangle box here, and you can see a support level there that was broken. All right, and a classic tenet of technical analysis is broken support turns into resistance. You'll see it in all of the textbooks. But you know what? It doesn't work all the time. Nothing works all the time. All right, another tenet of technical analysis is if you get a big move, like a move down, you could expect a reversal after a 50 or 61.8% retracement. And so we do the Fibonacci retracements tool. I'm going to click Fibonacci retracement, and I'm going to draw one from that January high to that December high to that December low. And I'm going to go ahead and color that gray. And I'm going to remove the numbers, kind of clean it up a little bit. And I'm also going to draw one from that October high to the low here for a reference point as well. And so when you put it all together, you say, oh man, look at this. We're coming into this broken support term resistance level. We're in this 61.8% retracement zone of one Fibonacci retracement, 50% of the other. This is where we're going to reverse. And we stalled for a little bit, even had this gap down, but we didn't break down and we didn't reverse. And instead, we continued higher. And I was on this bandwagon. I was marking this resistance level here, but when we started holding it, I then drew the pennant. All right. We then had a pennant formation form, and that is a bullish continuation pattern. And this is sometimes the short-term uptrend, which was the immediate trend, is the dominant force at work. Even though you think this is the dominant force, we had that breadth thrust on January 10th here, and we just continued higher. And so that's the first resistance level that didn't pan out. And once that didn't pan out, you started saying, maybe this rally has more legs than we thought. And then the next resistance level is going to come in at the 200-day, and then there's the other 61.8% retracement. So you kind of put a little red zone there. Go ahead and color it red. And you can see, okay, this is a great place for resistance. We even got a little move down there. Okay, it's working. Oh no, wait, we're back above it. And so now we're back above the second resistance level that did not hold, the 200-day and that 61.8% retracement. Actually, these retracements are areas you might expect a reversal. All right, they're not necessarily resistance. But resistance, 200-day could be resistance. Personally, I don't use the 200-day for resistance because why would it mark resistance? Now there's a third resistance level coming into play, and admittedly, it might be a little bit more robust because this is the area that prices failed in the past. All right, you can see here at this high, I'll go ahead and cover that a dark red, and this high, selling pressure came in. So 3 times around 2,800, 2,825 selling pressure came in, and here we are again, and we got some selling pressure yesterday after a strong open. So this could be the one that actually works here. It's the third one. But I'll show you, I don't see any weakness in the breadth indicators or in the trend. The trend is still up, and the percentage of stocks above the 200-day EMA. The other thing going against the market is, if you take that from the close to the close, we're up like 19% in 41 days. And I'll color that green since it's in advance. So, discretion is sometimes the better part of valor. And when you're up 20% and you're at a potential resistance level, the odds of a correction or a pullback or some sort of sideways action are increasing. And so we could see that in the coming weeks. And we can also throw in a third thing, and that would be that RSI has moved above 70 for the S&P 500. Now, longer term, that's a bullish indication usually. The ability to become overbought takes strong buying pressure. Shorter term, you can get some mean reversion in that, you become overbought and you do some backing and filling and maybe a pullback. So maybe we could get some pullback here. So when I look at the breadth indicators, I'm seeing very minimal selling pressure, and the short-term uptrends are still holding. So this chart shows AD%, which is basically the percentage of net advances. Advances minus declines divided by total issues for the three indexes, S&P 500, S&P Mid-Cap 400, S&P Small Cap 600. And when we look on this chart here, we can see that we had these moves above 70%, with the S&P 500 leading the way there because we had 1, 2, 3, 4, 5 moves above 70%. And it hasn't been below minus 70% since that latter part of December. And the move started with that big breadth thrust there. And then another one about a week and a half, 2 weeks later. But you can see over the last, since late January, this 80% indicator has not been below minus 40%. That's how limited selling pressure has been. The same for mid caps and the same for small caps. Hasn't been below minus 40%. That is how limited selling pressure has been across the board. So, until we get some sort of downward thrust below this minus 70% level in these indicators, we don't have that increase in selling pressure that usually signals some sort of a top, like we had in December here, when we had that big move below minus 70% in all three, and that led to that decline there. So until we get that sign, we don't have any signs of a reversal. This next indicator shows the percentage of stocks above the 20-day EMA, and the horizontal lines are at 70% and 30%. And you can see here that all four of them moved above 70% on January 8th there with big moves. And they've all, three of the four have been above 70% since January 8th. The only one that dipped below 70% was the small cap indicator, but the Nasdaq 100 held, mid caps held, and the S&P 500 held. And as long as these remain above 70%, the vast majority of stocks are in short-term uptrends. And until we start seeing moves below 70%, the bulls are clearly in control, even though we're overbought and at potential resistance. So now I want to dig down a little bit inside the SPY ETF and the QQQ ETF and look at the holdings and see how they're performing. And what I did was I Googled SPY holdings. You can add ETF if you want, and you can see a number of hits, but you need to go to the Fund Family website, and you can find the holdings there as well as the weightings. There's a link for the holdings. And there we can see Microsoft, Apple, Amazon. Of course, Google's twice because of this silly Class A and Class C share, but together they account for around almost 3%. So it's, the third biggest holding in SPY. If you break down and look at these I'm going to look at the top 12 stocks, and you can see it's pretty split. So I'm here on the charts and tools page, and this is always a great place to start for your analysis and stock charts because, you got sharp charts, point and figure charts, perf charts, candle glance, and all the charting tools that you could ever want on one page, as well as the nice summary pages. If you haven't seen the market summary, this is a page you need to check regularly because it shows you what's happening in the market in a nutshell. We got things grouped, major markets, major indexes, then we go down to the sectors, then to the U.S. industry group indexes, and so on. But what I'm going to do is I'm going to go to the top of the page here, and I want some candle glance charts for the top holdings in QQQ. So what I did was I pasted those symbols separated by a comma. And from Sharp Chart, I'm going to select Candle Glance. So I'm going to get all of these charts, small candle glance charts, so I can see in a glance how the broader market is performing. Now, I have arranged these in a particular way. The first 6 are above their 200-day moving averages. The red line is a 200-day moving average. And then the bottom 6 are below their 200-day moving averages. So if we just go by that one metric here, 6 could be in longer-term uptrends because they're above the 200-day, and 6 could be in longer-term downtrends because they're below. How's that for a split market? Keep in mind, these are the top 12 components for the S&P 500. So let's look at them excuse me there. Let's look at some of these individually. And I'm going to pull out my little screen marker here to give us some basic annotations. Microsoft, definitely one of the leaders recently, broke out of that pennant formation that was mentioned in Don't Ignore This Chart a couple weeks ago. Johnson & Johnson, not sure what to think of it, but it's back above its 200-day and is rising here, even though it had that big gap. But you can see it's starting to, well, it's not a gap, but a big decline. Look at ExxonMobil. It's above the 200-day, but I would not have a lot of confidence in this one because energy is still one of the weaker sectors overall. That could be a wedge, and a wedge break there would be clearly negative. Then we look at Bank of America. Now, the financial sector is still kind of struggling, all right, but I would put a support level there. I would raise it just a little bit at 28. And if we go below 28 in Bank of America, I think that's going to be a negative, and that could weigh on the market. You can see it's battling the 200-day. I would give it the benefit of the doubt because of this gap above the 200-day, kind of a pennant consolidation breaking out of. But if you go below 28, all bets are off. United Health, kind of looking shaky. You got support there around 258 or so. You look at Visa, part of the payments group. It's got a breakout and it's doing all right. And then we get to the weak half of the S&P 500 SPDR. And we got some interesting support levels to watch, especially in Apple. Look at that low from February. These February lows hold the key pretty much. Look at Amazon. All right, if it breaks below the February lows, if you get Amazon, and I'll throw in Google, Amazon, Apple, and Google, if they break these February lows, then we got an issue in the market. All right, so those are 3 definitely to watch going forward. And you can see Apple is kind of holding above that level, below its 200-day. Amazon is below its 200-day and hasn't gone anywhere, hasn't participated in the rally. We've had a rally since the latter part of January, and Amazon has not participated. And Google's kind of falling flat. So these are definitely 3 to watch. Going back to banking, JP Morgan, if it breaks 100, that's going to be quite negative. Berkshire, if it breaks down, it's the biggest holding in XLF, so that's one to watch. Facebook, I'm not sure about. Okay, yeah, maybe this is a little flag wedge and we're breaking out of it. but it's below the 200-day and has done nothing since that gap up, basically. But you can see overall, if you look at the top 12 stocks for the S&P 500, it's a pretty split market. And I would be focusing on these February lows for a lot of them. Apple, Amazon, Google, JP Morgan, and then as we saw above, Bank of America. And you start breaking those February lows in these key stocks, and the market is going to move into pullback mode. So I did the same thing for the top 12 stocks in the Nasdaq 100, and you can see that they are listed up above their candle glance. And there they are. I went to the Invesco website, which is PowerShares, and looked for the QQQ holdings there. Now on this candle glance group, I'm showing a 2-month candle glance chart. You can change the duration there at the top. 2 months, I think, is pretty good for candle glance. Now I'm going to add an indicator, and then you can sort by that indicator. So say we add the percentage price oscillator, and I'm going to put this at 1 for the short moving average, 200 for the long, and the signal line, I just want 1. And I'm going to click Go. And so that shows me the PPO 1-200-1, which means if it's positive, that means the PPO, the price is above the 200-day moving average. And if it's negative, price is below the 200-day. And with that, I'm going to sort. And I'm going to sort descending. So I get the top ones at the top, the highest ones. So we can see at the top we have Netflix, and it's 14.8% above the 200-day. Cisco, 14.5% above, and Intel, 11.8% above the 200-day. That's what's measured there with the PPO 1-200-1. And there you can see on the chart below, above 10% there, there's that 0 line. So these are the 3 big leaders as far as QQQ is concerned. And as far as drawing, well, the only thing I see is maybe some sort of a breakout there for Netflix, but I don't see any patterns in Cisco or in Intel other than, uptrends and strength here, clearly. Then moving down the road, we can see Microsoft would be next, 8.8% above the 200-day EMA. Adobe, 8.3%, both part of that strong software group. And Comcast, 7.5% above the 200-day EMA. And then we get to the weaker stocks, all right? They're still above the 200-day EMA, PepsiCo, Facebook, and Google, as well as Amgen. There you can see it's barely positive. And then Amazon is just below the 200-day, and Apple is 3% below the 200-day EMA. So Apple would be the weakest of these 12 according to this metric. But there you can see Google and that support level to watch, Apple and the support level, Amazon and the support level to watch. Amgen is kind of interesting because it managed to firm after this gap here. And if it can get a breakout there, that would be a bullish development for Amgen. So, and it's in the healthcare group, which is one of the stronger groups out there right now. Now this page here shows the candle glance charts for the 11 sector SPDRs plus SPY just for good measure. And the red line is the 200-day moving average, which is kind of like a reference point that we can use to compare performance. I don't want to go into detailed analysis of every single sector, but I just want to point out is, see, we've had a pretty good move since the latter part of January in XLY, in XLK, in XLI, in XLV. So these ones are continuing to lead. XLF to a lesser extent, but the clear one that is not participating as much is XLC because it remains below that early February high and below its slightly downward sloping 200-day moving average. So it's got a little support level there, say at 45, And if it moves below that, then that would be negative for that sector. It's around 10% of the S&P 500. And then if we go down to the bottom half of these sectors, the first 6 that I showed you account for 78% of the S&P 500. They are the main drivers of the market. You know, materials and utilities and REITs are each about 3%, so they're not weighing that much. They're kind of just a rounding error. But one thing I'm noticing is energy is below its 200-day moving average. So other than XLC, it's the only one below its 200-day moving average. So it is still one of the weaker sectors out there right now. So bonds are at an interesting juncture. Now, I've got this IEF chart, and I put a little underscore just before the symbol, and that means it's unadjusted. So I'm looking at IEF without the distributions, without the dividends. This is just the pure price action chart here. Now, before we look at this chart, I want to show you a little trick with Bollinger Bands. I'm going to go ahead and change this to TLT. And I'm going to change the indicator from price to Bollinger Band width. And then I'm going to take off that simple moving average and add the Bollinger Bands. And for the style, I want to choose area. The color is your choice, but I'm going to go with pink or fuchsia, if you might want to call it that. Opacity, I'm going to set the transparency to 0.3 so I can see the bars behind that. And then I'm going to click update so we can see what's happening here. And we can see that there is a Bollinger Band contraction working. And I'm going to go ahead and shift this window to 0.5 because it was the same size as the price window, but I want to make it a little bit smaller. So what we have here is basically a Bollinger Band contraction working. And you can see there's, say, 2%. And if you draw a line there, you can see that we've dipped below that level in November and here in February. And so we can see that the Bollinger Bands have been contracting for most of the month of February as we kind of move sideways. And if we do a little bit of drawing on this chart, we can see maybe some sort of a triangle consolidation. And I'm watching for the breakout here. It's always a challenge where to put your support and resistance. Now, as far as Bollinger is concerned, you know, the signal comes when you break above the upper band or below the lower band. The Bollinger Bands don't give you an idea of which way we're going to go. And as you can see, we've already had a break to the upside there. So right now, that's an active signal. That's saying that bonds are poised to move higher because of that break to the upside. And if you move below the lower band, that would clearly negate that signal. But the main point is bonds are coiling up to make a move, and that move could be sooner rather than later. Now, going back to this chart, what I like to do as well as plot the ETF at the top, the bond ETF, I like to put the respective treasury yield down below. So below I've got TNX, dollar TNX, which is the 10-year treasury yield. And you can see here that it mirrors what's happening in treasury bonds. So treasury bonds were breaking up to the upside in November while treasury yields were breaking to the downside. And that was a new low in treasury yields below 2.6%, and then consolidated with a pretty tight look at that tight consolidation in the last 2 weeks or so. And so now we're gearing up for the next move. And my guess would be down because I usually favor the continuation of the prior move. So basically what you have here is there's the sharp decline. This triangle is a consolidation after that decline, so it's a rest, and I expect a continuation of the previous move, which was down. So if we break support here, that's going to argue for a continuation lower. And if you look up at the IEF chart above, if you break up to the upside there, that's going to signal higher prices for treasury bonds. So where and when can you watch On Trend? Well, if you want to watch it when it first comes out, you can do it on Stock Charts TV. And of course, there's a link at the top of every web page for Stock Charts TV. And if you scroll down below the current show, you can see the upcoming shows that we'll be showing. So I'm going to do a show on breadth indicators this morning, you can see. And then On Trend will be on Tuesdays and Thursdays at 10:30 a.m. and then it repeats again at 11 a.m. Eastern Time. And if you scroll down, you'll see it's going to repeat again at 5:30, so you can always catch it later on. And if you miss it, you can click the replay link, or there's a link there for a live replay link, and that will take you to our YouTube page. And that will show you all the videos available on Stock Charts. You can see we got Market Watchers live there at the top with Tom Boley and Aaron Swinlin. Then In the Know with Rick. And then you have On Trend with yours truly, as well as Market Buzz with Greg Schnell, MEM Edge with Mary Ellen, and some shows down below there. So if you click full playlist, you can see all the videos for On Trend. And Thursday, I did a big video on the 200-day moving average, and I tested it for the S&P 500. And that video has a long shelf life. It can teach you about moving averages and dividend drift. And I will do some shorter-term moving averages this coming Thursday. So I tell you what, there's not one stock that divides the street as much as Tesla. You've got some pundits like Jim Chanos who think it's going to zero, and then you have other pundits that think it's going to be at $4,000 a share in 5 years. But if you look at this chart here, this is a perf chart year to date. It shows the main auto stocks. It includes the new NIO, the Chinese electric car maker. But you can see that all of them are up year to date. Fiat, Honda, Nissan, Toyota, Volkswagen, Ford, GM. Tesla is the only one that is down. So Tesla had basically first mover advantage as far as electric cars were concerned. And, after they had this big breakout of this wedge in early 2017 and hit new highs, it looked like, Tesla was on its way. But then something happened in the middle of 2017. And while the market continued higher and went to new highs in October 2018, Tesla could not clear these highs. And it has gone nowhere over the last 2 years, roughly. And if you look at on a daily chart, it looks even worse. So here's a daily chart, and we'll just do a live annotation here. So the trouble started when you broke below support there in December. And so the market took off in the latter part of December, but Tesla did not partake the entire time. And instead, you can see that Tesla gapped down there in the middle part of January. And that is clearly a negative. And that gap held because you had what was basically a counter trend bounce that looked a bit like a rising flag, or maybe even a wedge, depending on how you're drawing it, but I'd say a flag. And then you broke down below that flag, and it looks like we're continuing lower for Tesla. And I would mark resistance there at that 330 level. But I would be very concerned with this underperformance and this downtrend and the fact that it's gone nowhere when it had the chance. All right, so that concludes this edition of On Trend. Thanks very much for tuning in, and remember to stay on the right side of the trend. Have a great day.